Hi everybody, come on in, make yourself comfortable. We'll get started in about 1 minute's time. Thanks for joining us. Come on in, make yourself comfortable. We'll get started in about a minute. Okay, well, welcome to our webinar on a macro perspective on global investment markets. My name is Jeff Thurek. I'm a director of Australian Advice Network and Everlesco, and I'm very pleased today to be joined by Matt Sherwood, who's Head of Investment Strategy from Perpetual. And I'll give Matt a full intro and tell you all about him shortly. Before I do that, just wanted to let you know that for today's webinar, you at home will be on mute and your cameras are turned off, so we can't see or hear you. We do encourage questions though, so down the bottom of your screen, you'll see the Q&A box, and we'd love for you to type in questions in there as you think of them. Matt's got a lot of fantastic information to share and some great stories to tell of what's happening at the moment. So we'll probably hold the questions to the end of the session, but we'll make sure we have plenty of time to answer those. Also need to tell you that most of our conversation today will be on general financial markets and strategies that Matt and his team are employing. So I'm reminding you that all we're discussing today is general advice only. So even though most of the people watching along are clients of Australian Advice Network, we're not currently taking into account your personal circumstances. So if you would like to talk further about it, please contact your advisor or reach out to myself. So that's all the housekeeping, but now I'm going to introduce you to Matt Sherwood. So Matt is the Head of Investment Strategy Multi-Asset at Perpetual. So in his role, Matt is responsible for monitoring, analysing and forecasting earnings growth, interest rates, currency, economic growth and policy implications across major regions. And for context, from an AAN viewpoint, Matt is the investment strategist for the Perpetual Diversified Real Return Fund, which makes up 20% of the AAN core model portfolio. So Matt joined Perpetual in 2005, and his viewpoints and analysis of international developments are frequently sought by policymakers, opinion leaders and investors in Australia and Asia. Matt's previously been a panel member who discussed macro issues with the US Federal Reserve on a quarterly basis, and has briefed the BIS and G20 on several occasions on balance sheet issues facing the global economy. His current research is focusing on the COVID-19 virus and how fast and sustainably the global economy can recover, and what the portfolio implications of a record low bond yields are. Matt has a Bachelor of Business from University of Newcastle and a Master's degree in Economics, Finance and Econometrics from University of Sydney. And he's also held lecturing positions with Kaplan Education and has lectured MBA classes from Case Western University in the United States. And without further ado, over to you, Matt, to take us through your slides.
Well, thanks very much, Jeff, for that intro and also for the invitation to present our views and portfolio approach today. Now, in history, there are decades where nothing happens, and there are weeks where decades happen. And I believe that the COVID recession and its aftermath has changed a lot of things which investors, consumers and policymakers took for granted. So I suspect that 2020 is one of those transformational years, much like it was in 1961 when President Kennedy proposed going to the moon, and that facilitated a 50-year communication investment process. And I also view it kind of a bit like 1989 when the fall of the Berlin Wall not only sparked the reunification of Germany, but it sparked the end of the Cold War and, of course, the 30-year peace dividend. So looking at COVID, I kind of sense that the investment landscape has become a lot more complicated than it was pre-pandemic. And the key considerations for investors really is how to position in a world where there is very rich valuations, there is strong inflation, and there's very high uncertainty. And that is the question I will hope to answer for you guys today. Okay, well, in many ways, markets simply trade, market prices reflect two things. They trade on information. One of those two key drivers is earnings growth. So what we can see on the left-hand chart here is that in the first 18 months of this new cycle, earnings growth and price growth have been very different. And that's nothing new. What we can see here is that in two of the past three cycles, we have seen price growth in the light blue and earnings growth in the dark blue divulge by around 25%. And that occurred after the recessions of 1991 and 2009. And what we can see in the gold is that there were losses in the subsequent 12 months as that gap between earnings and price growth normalised. Now, the earnings price differential this cycle is much larger at 45%. And this difference will have to normalise, and this is really what gets me pretty cautious about the period ahead. Now, what we can see on the right-hand chart is the total value of US private sector equities and real estate. And of course, this has been very different to the fundamentals we see, for example, here, such as economic output, the purple GDP line, particularly over the past 40 years. And in fact, the very strange thing when you look at it is that there's not much relationship there between those variables, but there is a very strong correlation between the assets of private sector people and also the debt and the credit creation, which has ensued in this past 40 years. So really the long-term value of assets has been driven by leverage, not by the cash flows which the assets actually provide us all with. And of course, this has been a very long-term trend, as we can see on the right. You may be asking, okay, so what's the problem? Well, I think there's 5 challenges out there which has got me concerned about a market pullback. Now, what we can see is that the surge in debt was facilitated by lower interest rates. And for decades, central banks were able to ignore the distorting impact that their policies were having on asset prices, thanks to low inflation. The challenge from the last slide is that investment returns would have been pretty mediocre without falling interest rates and the debt that it funded. So the first challenge for markets can be seen here on the left, and that is that interest rates really can't fall anymore. And that's the case really for 2 reasons. What we can see on the right is that the first reason is that central bank short-term interest rates are already at 0. And yes, they can go into negative territory like they have done in Europe and Japan, but that actually creates more and more volatility. It creates a weaker economy, and it sparks, a lot more volatility in markets. And of course, the second reason why it's difficult for rates to go lower is that we now have inflation in the US at 30-year highs, as you can see in the light blue. And of course, that's something that we saw yesterday in Australia, where inflation is back within the RBA target band for the first time in 6 years. What's been driving this? Well, first of all, it was rising oil prices in the March quarter. Then it was this impulse was amplified by fiscal power and supply chain constraints in June, and then it went back to rising energy prices from decarbonisation in September. Now, of course, that sets up the second challenge in that rising inflation is now placing a lot of pressure on central banks to wind back their ultra-accommodative policies, which have been very central to the market rally since March 2020. Not only do they have to wind this back because inflation now is above target, but also because inflation itself depresses real policy rates and makes them even more stimulative than the nominal rates suggest. Now, if we cast our minds back to May, US Fed Chair Jerome Powell said he wasn't even thinking about reducing policy. And at that stage, asset purchases were running for America at $120 billion per month, or around $170 million of purchases every single minute. What happened in September, of course, is that he went a lot further. He did everything bar placing ads in the paper, saying not only are asset purchases going to have to start declining in November, they're actually going to cease probably by June next year. And by the way, we're now expecting, at least the committee is, to have 4 interest rate hikes in place by the end of 2023. Now, between May and September, that's an incredibly aggressive change in policy guidance. And what we can see on the left is that over the past decade, the 3 times when asset purchases have turned negative, in other words, the 3 times when the gold line has been below 0 on the left-hand axis, the global share market in the dark blue has recorded a decline of 10% or more. Now, clearly, no rule lasts forever, but that's a fairly consistent relationship. But of course, markets don't think that policy withdrawal will only be limited to asset purchases. Futures markets are saying that interest rates will have to rise also. Futures markets have priced in 6 rate hikes by the Fed by the end of 2023, the same for Australia, and just a bit less for the UK. And of course, the timing here creates a third challenge for markets, in the sense that central banks are being forced to hike rates at a time when the global and regional economies are slowing anyway. What we can see on the chart here on the left is that quarterly growth numbers this year are incredibly high due to stimulus, vaccines, reopening, and the improved nature of private sector balance sheets. But of course, the boom we can see in this chart is already starting to deflate from this very high base. And of course, the sharp deceleration we see in 2022 reflects the very poor quality of the stimulus, which was mostly cash handouts, and this is going to produce absolutely zero economic bounty at the end. In the gold there, Australia looks stronger than its peers because we have a reopening dynamic currently underway, and that's going to be supported by a high savings rate, strong house price growth that we've seen, and also, I would argue, a highly generous budget before next year's election. The second issue on the growth front is fiscal withdrawal, which is currently slated for next year. In 2020, we saw that when fiscal and monetary policy worked together to boost growth, it produced a very fast and powerful recovery. But next year, we will see both policy arms combining in an attempt to slow growth. In 2021, there already was a large fiscal consolidation, as we can see here on the second last set of bars, and that consolidation was mostly centred in the emerging markets. And this was offset by still a very strong surge in advanced economies growth. But of course, next year, the large fiscal consolidation is centred in the US and Europe. And it's unlikely to have a similar regional offset like we saw this year, although there will be a very strong private sector recovery, which keeps things afloat. But of course, there's another angle to the growth challenge for next year, and that is China. Now, if there was one country or one economy which turbocharged the post-GFC recession, the post-GFC rebound, it was China. as it underwent a huge leverage surge. This impact here is represented by the gold line and the big increase it saw between 2008 and 2010. And that, of course, sparked a massive construction boom in China. And this sector is now just under 1/3 of Chinese economic activity and around 1/5 of overall Chinese growth. But President Xi sees property supply as excessive, and I tend to agree with him. China, as such, has tightened financial credit provisions for over a year, and the credit impulse, which is the gold line here, is now starting to materially decline. And I think this is the best lead indicator for not only Chinese nominal GDP growth, which is so important to Australia, but also corporate earnings for the region. So that's signalling that there is a notable slowdown ahead. But when you actually think about China and all the challenges it has, property probably isn't really front of mind. In the essence, China is in a race to get richer before it gets older. And over the past decade, their debt has surged, as we can see on the right-hand chart on the left-hand section of it. So a decade ago, China's total debt to GDP was around 60 to 70 percentage points below that of the US and Europe. But today, it's above them. And of course, that's not a good position to be in if you're China, because its living standards, with economic output of about only $8,000 per worker, being much lower than it is, for example, in the US at 65,000, Australia 55, and Europe 40. So they have received very little income back. They have received very little income bang for their fiscal or debt buck. And in addition, China's working age population is set to decline this current decade, as we can see on the right, which will obviously pull down their potential growth rate. And of course, they have other economic vulnerabilities, such as being dependent on foreign energy, having their trade domiciled in US dollars, and of course, being dependent on foreign semiconductor imports, which is obviously one reason why they are aiming to acquire Taiwan through time. Okay, so what we've seen so far is that interest rates are rising, inflation is increasing, policies being withdrawn, and growth is slowing around the world. So this suggests to me straight away that we need to give risk management in portfolios a much larger focus than it has been perhaps in the last 18 months. Because we want to protect those strong gains we've seen during that period. Now, the first question to ask is whether there is enough earnings growth out there to offset the impact that higher interest rates have on valuations. And we saw that, of course, in the first chart. Now, weaker growth and higher cost side inflation have obvious implications for earnings growth. And our proprietary earnings model here on the left picked this up around June when it began to decelerate. Now, the model says that earnings growth will peak early next year at around 40%. This is in the US market, but by June, that 40% figure will have quickly slowed down to around 14%. Now, that's still pretty good earnings growth. But that's before we get the large US fiscal consolidation that I spoke about in the past few slides. And if that's the case, I tend to think that we may not yet be at the end of this downgrade process. Now, of course, analysts have begun to factor in our view and hence have ceased upgrading their economic outlook and earnings outlooks, as we can see in the gold line on the right-hand chart. And they are now signalling that earnings downgrades are likely ahead. And this means that earnings growth is likely to start declining as we go into 2022. Now, the fifth challenge at the moment is that there's a pretty large disconnect between what the market sees and what they're actually doing in their portfolio. So what we can see on the left-hand chart is that the number of fund managers out there who believe that the economy is going to slow is now, quite significant. And as such, what we can also see, though, is that they are still holding a very strong exposure, particularly in the equities part of their portfolio. So they think that growth's going to be weakening, but they're hanging on to their equity investments. And that seems a little bit counterintuitive, because normally slowing economies are associated not only with weaker earnings growth, but also with much higher share market volatility. Now, of course, that creates a combination of not only rising inflation and interest rates, but also the fact that we have now passed peak growth, as we saw, peak stimulus, and of course, we now have moderating earnings growth. And this, of course, creates two dilemmas for investors. The first dilemma they have, or the first question they have to ask, is that, well, if that's the backdrop that I'm operating within, how exactly do I grow my wealth when equity markets are quite expensive? And what we can see on the left-hand chart, again with the US share market here, is that at the moment, the S&P 500's valuation at 23 times earnings has historically been associated with share market returns on average in the next 5 years being minus 2% per annum. Now, of course, what that means is that perhaps the US share market may not be the great investment that it has been for the best part of 10 years. And there may be other markets, though, which have better valuations and, of course, are more aligned with returns of inflation plus 5% over rolling 5 years. And these sorts of markets are regions such as Europe, where we saw earlier that it has a better outlook for growth in each of the next 4 quarters. It's got a smaller fiscal withdrawal coming in 2022, and it's got a central bank which is going to remain ultra accommodating. Another good region, of course, is Australia, because Australia has a high proportion of its returns in income, which are not only tax advantaged, but dividend income has a lot less volatility than earnings growth itself. And another region we like within the fund is the UK. Now, of course, the second dilemma for investors, other than how do they grow wealth given where equity valuations are, is how do they diversify equity risk when bonds are even more expensive than equities in the first place. Now, traditionally, Australians have done this by buying exposure to Australian Commonwealth government duration. And this has proved highly successful on the right, as we can see on the right-hand chart, because since 1980, bond markets have returned an average of 15% in years where Australian equity returns have been negative. However, they're not going to continue to deliver those kind of returns, even in negative equity years, because the starting yields in bonds are so low. And I tend to think that bonds are going to be more like the first or the the first 75 years of this chart, on average, where they returned around 1.5% on average. So to me, bonds may not be the diversifier of the risks that they once were. They may actually be the driver of it, which is going to create some challenge from a portfolio perspective. Now, of course, that's the investor's dilemma. The retiree's dilemma is similar, but it's also a little bit different. The question that retirees have to ask is, well, how can they actually fund their retirement life cycle in this current terrain? Now, retirees in Australia have traditionally done this with exposure to what I would call yielding assets, such as cash, bonds, and Australian listed property. Now, in 2007, retirees needed around $1.5 million worth of assets to produce an annual income of $100,000. But today, they need a lot more to produce that same amount of income. They need $2.5 million of retirement nest egg at REITs. They need $9 million of assets if they wanted to fund their retirement through high-grade credit. They need $17 million in government bonds, and the cash market, if they want to generate their income there, they would need a retirement nest egg of around $100 million. Now, of course, very few people in Australia have those kind of retirement nest eggs. But what you can see in this chart is that the only asset where the required nest egg is the same between 2007 and 2021 is Australian shares. But this is the most volatile asset class, and one which exposes investors to both sequencing and longevity risks, and more so than any other asset. And we saw in the last chart that bonds can't deliver that sort of diversification that it has done so in the past. And so it's really important to understand the impact that share market volatility can have on a portfolio nest egg, particularly in relation to sequencing risk. And so what I've done in this chart is that we have three investors. They're all going to receive the same return, which is 7% per annum, and they're all trying to generate income of $60,000 in this case, but which is indexed to inflation. So the first person we have here is an investor who receives a constant share market return of 7% per annum. And what we can see is that if he starts out, or she starts out with $1 million retirement nest egg, it progressively gets amortized down, and they run out of funds at the age of about 89. But that still funds a pretty good level of standard of living in retirement. Now, the second person also receives an average 7% per annum. But what happens for this person is that they're pretty fortunate because they get very strong early returns in their retirement, like we can see here. So the first 3 years, in fact, of their retirement, they gain a return of around 50%. And what we can see is that if you get strong early returns, then that person, even though they've got the same return as the green person, just has a much larger nest egg generally through time, even though they do have years of capital losses, such as we see in years 4 and 5. Now, the third person I have has exactly the same return dynamic as the blue person. They get an average 7% return. They have a volatility or a standard deviation of 13% in that return. What they have, though, is that those 5 years of returns in the blue are just ordered the exact opposite way. So they have early losses followed by strong returns later on. But what we can see is that the impact on their retirement nest egg is much more dramatic. And in fact, they run out of funds in their early 80s. So what that shows is that even if you have the same return and the same risk, the simple different order of the returns has a very profound effect on the value of your retirement nest egg, which after 20 years or 19 years of retirement is actually the difference is $1.3 million. And that shows the difference between time-weighted returns on the right-hand side and money-weighted returns over here on the left. And this really tells us why risk management is so important for retirees. And so the way that we try to manage this in the Real Return Fund for both investors, the accumulators, and those who are drawing down their superannuation as retirement is by asking for very simple investment questions. The first two is about returns, and we ask, well, what's got probabilities of protecting against inflation surprises in the next 5 years? And the sort of assets that we like to put in that portion of our portfolio are things where, like property, where rents are tied to inflation, and also commodities, as we see this year, which can be the drivers of inflation. And then once we've answered that question, we then move to the top right-hand box and we say, okay, well, what actually has a high probability of beating inflation by 5% over rolling 5-year periods? That's 5% per annum, I should say. And from here, we're not just thinking about equities, we're thinking about large cap and small cap equities, Australian and global shares. We're thinking of credit, both high grade and high yield. We're thinking there about Australia versus the US, Europe, Britain, you know, and it really depends on which risk premium there we're trying to extract. Now, once we've figured those two parts of the return part of these quadrants out, then we ask two very important questions. The first one is actually down the bottom right, and that is, what investment opportunities are out there which have a zero correlation with equities? Things we're looking there are, you know, a kind of spread trades in fixed interest, for example. It could be foreign exchange investments, which tend to have very low correlation with equities. And we combine those sort of, you know, spread trades with explicit downside protection in that left-hand bottom quadrant. And there we're talking things like we can have duration in there in cash, but generally we like to try to get convexity into the portfolio through the explicit use of bought put options, which really can give really good returns when volatility is increasing and share markets are heading lower. And the big thing about the 4-quadrant approach, of course, is that each weight for each quadrant is not static. So it evolves as the cycle evolves. So the composition of the real return fund, for example, in a recovery where valuations are cheaper, earnings growth is stronger, policy still supportive, we're going to have more exposure generally to the risk-seeking, the return-seeking part of the quadrants. We'll augment that, you know, with some inflation protection and also some diversifying opportunities. As we move clockwise around to a mature bull market and into a bear market, we can see that, you know, the asset allocation from recovery, which is more like a balanced growth fund, starts to look more and more like a conservative growth fund, where we're dialing back the risk allocations. We're putting a lot more diversification into the portfolio and a lot more downside protection. So all of this is combined within an overarching risk framework, which means that the portfolio can give people upside potential, but with downside protection. And that's really a combination which is ideal for those who are in retirement and also for those who are approaching retirement. Just to show you how it worked in the last cycle, what we have here in the green is the Australian share market. So since the fund began in October 2010, we can see that on 2 occasions, the Australian share market had losses of 10% 20% or more, what we term a bear market. And you can see in the blue how the real return fund performed during those times. There were also 4 occasions when we had a loss of between 10 and 20%, so what we call a market correction. And again, the drawdowns in the real return fund were shallower in terms of size, shorter in terms of time frame, and we're able to get the capital back for investors over much more quickly. So it really did the job for what investors wanted during those periods, and that was defending capital. And as such, that keeps portfolios on a really good footing to actually take advantage of dislocated markets that can occur from time to time. So in the end, when we're good returns and good risk management don't need to be, offsetting each other. So what we can see here on this chart is how the fund performed against some investment alternatives. So the cycle ended where that dotted red or purple line is. So since the fund's inception to the end of the last cycle, we got pretty much the same returns as Australian shares, but we did it with a lot less volatility. Now, of course, the real return fund here in the dark blue, it had much stronger returns than both the Australian bond market in the yellow and the Australian cash market in the orange. And of course, those lines, given where interest rates are in the current cycle, are going to be much, much lower. And so, we still remain very confident of delivering on the inflation plus 5% over rolling 5 years objective. In this cycle, even though equity markets have torn ahead, as you can see here. So overall, risk management has not been at the expense of our investors' returns. Okay, so let's just kind of sum the presentation up. What we can see is that it's a very challenging cycle at the moment, and it's challenging because we have passed peak liquidity, we've passed peak stimulus as we saw, we've passed peak growth, peak valuations, and peak sentiments. So I think really what the important thing to be doing here is focusing on that breaking news, in the knowledge that there's numerous headwinds ahead for 2022, such as central banks withdrawing policy, the China slowdown, which we saw. There are issues around the global labour markets, the fiscal cliff, and of course, higher energy prices. One challenge for Australia, of course, is going to be our how we're actually going to grow the economy. If we go back to this population growth model, then of course that means that wages remain stagnant, and that will be a real policy dilemma for the RBA. We focus on that breaking news, but not at the expense of the known news. So generally, we are anchored in a low nominal growth world, both for earnings growth and GDP. We know that bond yields are low, but they are likely to rise from here. And we certainly know that bonds won't be the great equity diversifier like they have been in the past. So, when I put it all together, what we know is that valuations are probably going to come down. Policies withdrawn, as I said before, growth slowing, and you put all those combinations together and it signals to me that risk management needs to be the key portfolio focus for 2022. Because in the end, we've had some fantastic returns so far in the 18 months of this new cycle. And my suspicion is we need to put greater focus on protecting those returns, given all the headwinds that are out there. So that's probably, that's it for the views and the summary of where we see things. So I'll hand back to Jeff at this stage. Thanks very much for your time.
Thanks, Matt. That's great. So as we said at the start, we'd love to get some questions if you've got things which are on your mind after absorbing some of that information. You've got a couple of questions which have come through, which are fantastic. So thank you for those, but keep them coming because we've got a few more minutes. I guess, from our viewpoint, Matt's talked there about risk management being a big focus. We've always viewed the diversified real return fund as a real shock absorber in the portfolio. And a couple of those last slides really bore out how that's being put into practice, and allowing the philosophy and the process to play out has meant that the team, Matt and the team, can make some more tactical decisions around how they allocate a portion of our clients' portfolios, and that's really protected well in those downsides, but also allowed us to participate in the growth over the last few years as well, particularly. So that's good to see that those slides are showing how it goes to work, and we're really pleased to have Matt and his team focusing on those risks and managing those on behalf of our clients. A couple of questions, Matt, that have come through, and as I said, keep sending them through. You talked about sequencing risk, and I think that was a really good illustration, that slide of the three different models. What are some of the things that people who are a couple of years out from retirement can potentially be doing to manage that sequencing risk, or should be thinking about?
Yeah, well, that's a great question, Jeff. The first thing I'd say is, I think as you approach retirement, you need to be having more and more conversations with your advisor and making sure that not only is your portfolio aligned with, your investment mindset, because some people are a bit more risk loving, some people are more risk averse. So you've got to make sure that your portfolio is actually aligned, not only for your investment mindset, but also, your age profile. So, I've got members of my family who are approaching retirement. So I'm suggesting to them that, you need to be having better risk management in your portfolio. They like the real return fund because they can still get participation in the equities market, which is so important for growing that retirement nest egg. But it's really the convexity protection that we give them in the fund through the use particularly of bought put options, and also just not having investments in the fund which, have poor risk return trade-offs, such as government bonds. So bonds have been a great investment for Australians, but I don't think it's going to serve them particularly well in the current climate. And the big question every investor needs to ask, but particularly those approaching retirement, is how do I diversify that equity risk? Because bonds won't do it anymore. They may do it if we come into a massive deflation shock, but inflation's going the other way. So, I'd be having conversations with my advisor about how I can get upside potential with downside protection. And as I showed in the chart, risk management does not have to be the expense of returns.
Yeah, great. Another question that has come through is in relation to China. So you had some commentary around China and some challenges that they're going to be facing. But on the flip side, talking about Australia as being, one of the areas of opportunity, how do you think that the challenges China's facing will impact the Australian economy and Australian companies?
Yeah, that's another great question, because obviously China's been very central to the strength of the Australian economy, really so far this century. And of course, China's particularly clamping down on its property excesses. I actually think this is very good policy from President Xi. It will slow growth, but at the moment, China's having a property boom which is getting out of control. And we saw in 2008 the sort of effects that can have, not only on economies and employment, but also on investment returns. So it's probably, I think the biggest impact of the China slowdown will clearly be in our exports. And our two big exports to China is coal and iron ore. Property itself is very steel intensive. And so we have seen iron ore prices come off. How's that going to impact the Australian economy? Well, I think the major impact will basically be through the current account balance and the trade balance. So I think our trade surplus will decline, probably still remain in surplus. And also the current account surplus we have seen for the past couple of years, I tend to think that's going to diminish pretty sharply. In terms of the economy, there will be naturally a reduction also in national income because iron ore prices have been such a huge cash cow generator for the Australian economy more broadly. But in terms of growth, I don't think a slowing China is going to have a dramatic impact on the Australian budget, because they've been factoring in iron ore prices of $65 a tonne. Now, iron ore prices have halved since the peak earlier this year, but they are still double the budget estimates. So I still think the budget will be okay. I tend to think that there won't be a massive slowdown in resource sector investment. They kind of learnt the lessons about 8 years ago of over-investing in capacity. They haven't made that mistake again. So there's not going to be a massive decline again in resource sector investments. And the other thing we have to remember is Australia is basically a services-based economy. It's not a resources-based economy like many people think. Resources are a big source of national income, but the service sector is a bigger provider of employment and of economic growth per se than the resource sector is. So I think we'll be able to manage it. It does mean policy rates will remain lower for longer, and I would argue the budget will take longer to return to balance. But I tend to think we can manage all these risks in Australia if we have sensible policy making.
Great. So we're coming up right on time, but I've just got one last question. So you talked about, again, the positive view of Australia based on consistent dividend income, and it's been a big driver of that. I guess how confident are you that that remains the case? That's kind of historically we haven't seen a lot of dividend revision. How confident are you that remains the case? And are there any sectors where you think that might come under pressure as a result of what we've seen with COVID and the challenges off the back of that?
Well, I tend to think that dividend income is still going to be a very large part of Australian share market returns. So, since 1882, Australian shares have returned around 11.5%, and an average of half of that has actually come from dividends. So 6% has come from dividend income. Now, the long-term returns from Australian shares have probably come down a bit, probably towards about 8%, but dividends are still going to be half of that. We have to also remember that dividends are still tax advantaged through imputation credits. In terms of sectors which are probably more vulnerable, well, you have to remember in Australia we have a very large reopening dynamic. We have households which have got high savings rate. We're going to have large employment growth, in the next 3 to 6 months. So I think the Australian economy over that period is going to be pretty strong. Unemployment probably won't go too much lower because it's still very low already, 4.5%. So I tend to think that the earnings performance will still be good. Resources, obviously, are at risk, and the other sectors are at risk of those who have large exposures to rising input prices there. Labour market costs are probably also going to grind up also. So firms with high number of workers, so normally consumer-facing type industries, they're going to be challenged. But if you've got your Aussie share investments in firms with strong balance sheets, they've got good operating models, who are surplus cash flow generators, you can ride these up and down waves, through cycle to cycle, and it still can produce a portfolio outcome which has got good income growth, good tax advantage through the franking credits, and good earnings growth overall. The big thing I'd be looking for is strong balance sheets though, because corporate balance sheets will become more stressed the higher interest rates go. And of course, that is one of the big focuses in our Aussie equities team, whose funds that we invested in the Real Return Fund.
Great, makes sense. We are just over time, but if you've got time for one more question, Matt, we've had one more come through at the last minute, so if you don't mind. So a question around inflation, which I think is, it's very topical, and you talked about it earlier in your presentation, lots of conversations about inflation at the moment. The question was kind of alluding to inflation's almost a new thing for most investors. Not a lot of investors haven't really experienced any real inflation in their investment history. So I guess how should they think about that? And do you think it's going to keep increasing? And is it here for a long time, or is it a transitory sort of feature of where we're at the moment, and how will that impact portfolios?
Yeah, so that's another great question. And you should remember, if in the start of my presentation I was saying that a lot of the old rules that people have taken for granted, consumers, investors and policymakers, they're probably changed. And of course, we've been investing and living through a 30 or 40 year period of disinflation or falling inflation more broadly. Now, when you look at the arguments of transitory inflation, most of the inflation coming through has to do with commodity prices. and shortages. The challenge with that, of course, is that whilst, well, the challenge really is the fact that the global economy is getting back on its feet in Europe and in the US and Australia and Japan. We're learning to live with COVID, but in Asia, there's a lot of them are still pursuing this zero COVID policy, which may mean it's harder for those economies to reopen up, and hence we could get what is now being called transitory inflation for longer. Now, my suspicion is some of this will have dissipated by the middle of next year, but that's still quite a way away. And of course, you've got to remember it's a different kind of inflation. So we've been living in a 30, 40-year period where inflation wasn't high anyway, but if we did have inflation, it was driven by demand, the demand side of the economy. This is different because it's driven by the cost side, and the cost side inflation is not associated with higher income, with more profit, and with better, debt management capabilities. It's actually the complete opposite. Cost side inflation leads to lower disposable income, lower profits, and it puts more pressure on debt burdens. And so therefore, balance sheet management is going to be very, very important. And of course, asset allocation and risk diversification, they're just becoming more and more important with this backdrop. So no one knows if it's going to be or how transitory it's going to be. I suspect decarbonisation is going to be a structural issue for the global economy this decade. I tend to think the supply issues around components and other corporate inputs will probably fade through time. But it's a very different climate, Jeff, than what we faced for a lot of years, and hence risk management in portfolios is still going to be the key barometer that investors need to keep their eye on, probably I would argue for the next 18 months at least.
Fantastic. I think that's a great way to wrap it up, Matt. Certainly, every time I speak to you and other members of your team, feel more comfortable and confident that we have you looking after the risk management and the shock absorber part of our portfolios. And hopefully, I'm sure our clients are feeling much the same after spending the last 50 minutes with you. So thank you very much for your time. Thanks to you and the team for all the work you're doing. And thanks for taking the time to answer the questions as well.
Thanks, Jeff, and all the very best to both you, and all your clients.
Thanks a lot. And thanks everybody at home for listening and your questions. A recording of our presentation will be available in the newsletter, which comes out and also be posted on our website. So if you want to go back and have a look over some of those slides or have a listen to some of the explanation, that'll be available to you as well. And thank you very much. Have a great day.